What's up, YouTube? It's Joe Catchpollia sitting on the couch making some money investing in fractional real estate online. As usual, today I'm going to talk about why you might be losing money investing in fractional real estate. I know there's a lot of people that are, depending on what platforms you've been on, you might have lost a little or a lot, or maybe you're just not making as much as you could be. One of the things, especially when I'm in the Lofty Discord, but a lot of the other discussions I've had with investors as well, um, there are people making similar or the same mistakes over and over again. And I was talking to this with a friend of mine the other day, and I think everyone really has their blind spots when it comes to investing. And so what I wanted to do is point out several of the ones that I've seen people, several of the common themes. Some of them that I fell for, some of them that have caused a lot of other people that I think are intelligent people to make the same mistakes over and over again. Some of these are things I've talked about before. I think some of them probably are new ideas or a little bit of a twist on the ideas, but it's a pretty long list. Hopefully, this won't be a 3 hour video, but I think that if you've noticed that you've been duped by co-owners or by platforms, or you've made poor investments, multiple times, things didn't turn out the way that you expected. Hopefully it's one of these things on this list is I think very likely the cause of why you made the decision that you did. Um, I'm going to go through this in no particular order, but they are all things that I've seen people do. So the first one I think first kind of blind spot is just being naive, right? Like taking things at face value. I think this is where most people their like first interaction with Lofty in particular. I think this is a problem, right? Like I know at one point Jerry said, "Hey, this LeClaire property is one of the most popular buys on the platform for a new investor." Well, I think it's because there are people, and it's the first one I bought on here, and I think that we're sort of naive. And so, for example, I just could not imagine that somebody had put this listing up 3 years ago. The property didn't sell out, and they were still selling tokens to it, right? Like I just took them for, I did the due diligence on the property, read all the stuff, all the info that they had. Um, didn't see any updated operating info, but they're long-term leases. So, uh, and I think if you watch my early videos, it was a little bit of a YOLO. I was using my free token for the first one. Um, but I really just took it at face value that this property was owned by the Dow, which it is not. So if that's news, I'm sure there's somebody watching this that's going to be news to, right? Like this property never closed. We see people all the time coming into the Discord saying, "Hey, I bought this. Why is it? What's going on with it? Whatever." I think taking that at face value, taking projections at face value, I think is this property, they have their projected annual return and their projected rental yield, and the actual rental yield is zero. And I think that you can find examples of this all over Lofty's platform for sure. But they're not the only one guilty of having, missing their projections. I know there's some of the arrived homes once did. I'm sure every platform is going to have some degree of that where they're going to have a property that falls short of their projections for one reason or another. I also think that there's a lot of people that are naive about how easy or hard it is to do certain things with the property, to operate the property. I hear people all the time say like, "Oh, well, just tell the property manager to do this with the tenant." Like, we'll just, sometimes it's really absurd in my mind, but it's because I've worked in real estate for a long time. But they'll be like, "Well, why don't we just tell the tenant, they can catch up, they can skip last month's rent, they can give us half this month and half next month," right? Like that's a payment plan that virtually never works for a tenant, right? If you're somebody who's renting, you don't have 50% of your rent extra in a month that you could apply to a payment plan. Like, stuff like that, stuff like, that I mean, you hear people bad mouthing the property managers all the time, thinking like all these third party property managers are terrible. Some of them are terrible. A lot of the problem is the way that we interact with them. But in addition, it's just a hard business, right? Like if there's not, a lot of times, especially in some of the C and D class multifamily that we deal with on the platform, you're just not going to have, it's not an easy operation. And so I think a lot of times, we just take certain things for granted, or, people expect like, oh, we can do a turnover so quick. One of the ones that really struck me as funny recently, if the Mount Vernon property that was struck by lightning and burned. People were talking about, hey, why don't we just build a new fourplex on that lot? And I mean, that sounds really good in theory, but the actual like process of trying to build a new, something from the ground up, is not something that I'd ever want to undertake in, within a DAO structure. I've only ever built one ground up project that's mine personally that I did 100% on my own. Uh, and it's definitely something you want to be able to go there every day and whatnot. But so there's a lot of like just pure naivete, however you say that word, around like what, how easy certain things are and what you should do. I think so. I think there's a lot of people, especially if you're new to real estate, that might be something that you're bumping into quite a bit. I think it's really helpful to go back and look through a lot of the property histories and just see like how long turnovers took, how expensive it was to do certain things. That's another thing. A lot of people are like, oh, well, you should be able to do this for X price. And it's like, well, maybe in your market, or maybe if you're just hiring a handyman, you're not getting someone who's licensed and insured and, whatever it is. Or maybe if you're doing most of the work yourself and you're just paying for labor, like there's a lot of times where people just have really unrealistic expectations about how certain things should work. Um, One thing about hiring contractors is the more professional they are, the more you're going to pay for them. And there's really always a trade-off. And if you're a large property manager and you're hiring contractors, it behooves you to just hire ones that are going to be professional. They're going to get the work done. You're not going to have to wrangle them. And so yes, it's going to be they're typically going to spend be hiring more expensive contractors than if you were just going to do search for the cheapest person on your own, and then you were just going to really babysit them. So, I think that's a whole category, but I'm not going to beat that to death. I think it's probably the most obvious one, right? I think people just it's clear there's just a little bit too much trusting in what people say, or that too much belief that that real estate investing is easy, or that finding deals is easy, right? Like one of the huge, like just crazy assumptions is that you could put any property you want onto a platform. Like Lofty is like, oh, you can list anything as long as it's legal. Well, then you're not going to have good investments. On average, you're going to have terrible investments, right? Like it's very naive to believe that like any property could be a good investment. It's in my day job, I help investors find properties in San Antonio, Texas, and at any given time, there's 10,000 listings on our MLS. And, in a given month, we might find 4 or 5 that I think are actually great investments, which means, 9,995 are not, right? So on average, properties are not good investments, right? Like you have to actually work to find the good ones. I think that's one that really falls into, just being naive about the situation as a whole. I think there's a lot of people that just have kind of made ideological, choices or decisions. Like, for example, when they're choosing one platform or another, like, one of the criticisms I've heard a lot about Mogul, which is one of my favorite platforms. And actually, before I forget, please like and subscribe. In the description to this video, I have links to all the platforms where I currently invest on in fractional real estate. Uh, don't just invest in those platforms because I do. Do your own due diligence. And any of the properties that I invest in or don't invest in, don't take that decision as the right decision for you. Do your own due diligence on the property, on the investment, because we're going to have different risk profiles. We're going to have different time horizons. And just because I think something about a certain property doesn't mean it's right. Also, in the description to this video, there's a link to the Discord that I have set up. We've got over 100 investors in there now. People talking about all different platforms on a regular basis, mostly Lofty, Mogul, Ground Floor, Saul's Lot, but really any platform that you're investing in fractional real estate that you want to talk about. I'm sure there's somebody in there that is either already on the platform, thinking about using the platform. So feel free to jump in and do that. And also, I think I said like and subscribe already, but just in case I didn't, please go ahead and do that. Um, Okay, but yeah, one of the criticisms I hear about Mogul is, oh, well, it's not decentralized at all, right? You have a single point of failure because it's the team that's like finding the properties and whatnot. And I think, I understand that there's people that like the idea of decentralization, um, but in the current world that we have as far as options for platforms, if that is the only, if that's going to be your number one priority, it's going to force you onto and not, a platform that is just not working great right now. Uh, I'm going to let you guess on which one that is if you haven't figured that out already. Another one is people just have this a chain preference, right? Like what blockchain is it on, or is it on a blockchain at all, right? Like some people have just ruled out like Arrived or Ground Floor because they're not using blockchain. Um, I'm trying to invest in real estate here. I'm trying to get the benefits of investing in real estate. I don't really care if it's on a chain or not, and I don't care what chain it's on. Um, maybe a little bit of that is just because I'm ignorant of the benefits from one to another. But one of the things that you'll see, there's a lot of people on Lofty are just big Algorand fans, and most of them, a lot of them got there and know nothing about real estate, and don't even want to look at different platforms because, well, no, I'm Algorand's the chain I'm looking at, or like you can tell looking at the crowd that is investing in Sol's Lot, which this is a platform I like a lot. Again, do your own due diligence. But I think that the majority of the people that are buying on here are doing so at the moment because they're Chia fans, right? They like that it's being built on the Chia blockchain. um, I had never even heard of the Chia blockchain before I heard about this platform, right? Again, I'm here for the real estate. I think having a chain preference, it could be something that weighs in your decision a little bit, but if it's what's, if you're picking one in real estate platform over another because of the back end technology that they're using, um, I don't think it's the way to find deals that make sense. Another thing you see a lot ideologically is like the platforms talking about like roots is like we have a win-win model, right? Like we're letting the tenants invest with us, they're winning, we're winning. Collab kind of has this sort of thing going on with them too, where it's like anybody can come and help do certain tasks, and they get paid through the Collab platform. Um, but you see stuff like that a lot, right? Like, okay, this is a win-win. This is the way we're setting it up. It's sort of like we're not just here to make money, but we're also doing good. Um, it's not that I don't like the idea, right? Like, I think having more financially stable tenants is going to be a good, investment. But I think a lot of times that the companies that do this are companies that don't have a great value proposition to begin with, and so they try to mix this together, right? Like you saw this a lot with like the Tom's shoes is when this became really popular, right? Like for every shoe that they sold, they sent one to some other country. um, but you ended up paying, like, they just were not great shoes, right? But people just loved the idea, and since then you've seen a lot of like similar companies where they're like, okay, you buy one of these and we send the money, but like you're paying a premium. You could just buy one that's better quality and cheaper, and take the money that you save and give it to a cause that you wanted to, right? Like I think anytime that there's this sort of like I can't think of what they call it, but compassionate capitalism, or there's another word for it. I think that there's, it's not that I want to just be like, crush tenants with an iron fist, but I think that there's like, I think it's overblown, right? I don't think that I don't think it's necessarily the best investment for the tenant to invest in the property that they live in. Maybe it is, maybe it's not. Um, but it's also, it's I think there's a more liquid ways that you could help a tenant, right? If that was really the goal. And I think a lot of this just becomes marketing. Um, you hear a lot of, like, in this one, I think this is, they have really good marketing. Rooch does, if you watch their videos. They're like, I think that they kind of are into the idea of like democratizing real estate investment. Like anybody can be a real estate investor. A lot of the platforms talk about that as well. Like, just anybody can do it. And I think that that's perfectly fine. Like I actually like that anybody can invest in these platforms. But I think that like when the platform is overly focused on that, like that they're on a mission to do that, that it is, um, you just have to recognize that that's marketing. That's you're not. It's not like you're. I would not change which platform I invest in because of the feelings that I get from creating that win-win or democratizing, real estate investing, right? I think that it's the deal first, right? The platform, like how good are the properties, how well is it run? If I want to do good with my money, I will probably just make more money on another platform, and then I'll give it away, to places where I see fit on a regular basis, right? Which I already do. So trying to mix the two, I think, is almost always. It's not always, but it's very often uh, done because there's a weakness in the model. It's not always, but a lot of times, and so they're trying to like tug at the heartstrings of people to use the platform that wouldn't necessarily do it otherwise. Um, Another one, and this is a major category, is sunk costs, right? Like, so this is, we talked about this a lot. A lot of people, they've put some money into a deal. All the tokens on Lofty started at $50. A lot of them are in the teens. People have lost money and they don't want to sell out until they get back to, this is one I've talked about a whole bunch. Um, and it's one that you just have to ignore, right? You have to look at what's the value of what I have today and what's the most profitable move forward with what I have today. So if this is really, I have an $18 token today, I pulled up Bowmanville because this is one that I had owned tokens in. We had, I proposed a vote to get it ready for sale. It's actually working on a sale. Um, it looks like to sell it, it's going to be a huge loss from anyone who bought it at 50. It was even going to be a loss for the tokens that I had bought, but a very small loss, but still a loss. But I was 100% on board with doing that because I think that taking that cash and putting it into another property that is doing well is going to be the quickest path to profit, right? Like taking that, sitting there and holding it because I really want this property to get back is, that's focusing on sunk costs, right? And so, and I say I was willing for that. The price popped and I just sold out right away. And this is, I think, another one, lost, people think about their lost time and effort too, right? Like I was the one who proposed the vote for this. I spent some time on it. Um, but I had no hesitation whatsoever about selling this as soon as those tokens moved to an amount where I was going to make a profit. Uh, why not just sell there instead of like waiting to sell the property in real life? But I think it is one of the things, a lot of people get attached to these properties, right? Like, oh, I've been working on this one forever. I've proposed a bunch of votes in it. Maybe they or the manager, for whatever it is. Um, that time and effort that you spent, that's gone no matter what, right? And so from this point forward, what makes the most sense, right? Does it just mean to move on? I think that there's a lot of that going on with platform loyalty. I'm jumping over one now, but here people are like, no, it took me 3 years to learn how to use Lofty. I finally kind of get it. I'm barely losing money now. Maybe I'm even figured out how to make some money. Um, why would I move to a new platform, even if that platform's better? And I think platform loyalty really comes from a feeling of sunk costs, from the time I've spent on it, from the decision that I made. Um, I also think like people don't want to change their mind because they don't want to look dumb, and I think this is really based on a sunk cost. Like you already made a bad decision, right? You already look dumb. Just acknowledging it and changing it, like you're the only one that is missing it until now is you, right? Like when you actually go and make that change. I don't know why this stuff bothers me, just changing that. So that's another big one, like focusing on sunk costs in a lot of different ways, I think causes problems. Wha- One of the biggest ones, I think, there's a lot of different emotions. Like when, people got angry at Yom, um, and I think we saw just a ton of bad decisions made that people weren't focused on. Okay, how do I make the most money from the point I'm at now? Yes, we got stuck in a terrible position. There were definitely people that were more focused on just kind of getting back at Yom or just really getting everything away from them than thinking about like, okay, what's the most profitable path forward? We know things aren't actually what we were sold initially. The deals, we're having a problem, but like realistically, like did it make sense to go after the co-ownership properties? Um, Even at the time, there was a lot of people that I had discussions with, and I was like, I just don't think you should do it. I don't think doing it is really motivated by making money. Um, you know, Whether or not it's that was a bad idea in retrospect, I think it's still not clear. And even once everything's said and done, we won't know for sure. But to me, the motivation there seemed very much more out of anger and maybe a little fear than it was out of like, okay, what really makes sense, right? Like, I think it was clear, like all of the DAOs that were about to lose, 3.5% of equity based on a vote if they didn't move within 30 days. Okay, that makes a ton of sense. Let's move all of those, save them the money, and then stop and figure out what we're doing. But going after the rest of the properties, I'm not sure. I think I know there's some people that lost money, and it really was, I don't know where that. I think at least in part, some of the people were motivated more by anger, or by like trying to stick it to him or something than anything else. Um, Fear is another one that all the platforms play off of, right? Like you have almost all of them, right? They're like, so for example, Arrived is very much, um, they're like they talk about, so they're a very low yield platform relative to a lot of the others, right? You're not going to make a ton of money compared to some of the others, at least in my opinion, when you look at the deals themselves. But so they focus a lot on, okay, diversification, and they talk a lot about, okay, we're Jeff Bezos backed. We have these, like, they try to make it feel like a safe thing. They focus a lot on these are actual securities. Actually, I think Real Bricks is the one that does this more. They're talking, okay, highly vetted properties, no hassle investments. Like, I mean, they're trying to help you. They're trying to alleviate the fears that people have when it comes to investing. Um, you just see it a lot. Yeah, your investment is fully regulated and protected by the SEC. Like what does that really even mean, right? I mean, I get it. I get that some of the platforms are not using, registered securities. All the ones that I invest on, they believe at least that they're operating within a safe harbor or loophole that allows them to operate in that manner. Whether or not that turns out to be the case in the future, we'll find out. But how much does the SEC registration actually keep you from losing money? I don't think it's very much. And this is again just my opinion. It is something that you want to dig into on your own. But yes, I think having audited financials, that's which is a requirement. I think certain standards that they have, of course, I think that provides additional safety. But if you're getting that same sort of transparency in a different type of investment, are they really protecting you? I mean, if you think about it, there are public companies that go bankrupt all the time. So like saying that you're protected by the SEC, it doesn't mean you can't lose money in the investment, right? And so, but you see stuff like this, and I think that there's people that are always posting like, oh, this platform is unregulated, and trying to create some fear in that. And it's like, okay, what's the actual risk for me as the investor from them being, a DAO, versus being a security? That's one of the things that you see quite a bit, and it's also one of the reasons why I think you see some people when they're buying properties, really focusing on, oh, what happened there? I'm going somewhere I'm not trying to. Really focusing on like the properties that like look really nice or in nicer areas. They kind of fear, um, and sometimes that's right. Sometimes that's one of the things that's hard about a lot of these blind spots is some of them are somewhat based in, there's some truth to them. Like, yes, I don't want to be in the absolute worst markets, but it doesn't mean that I need to have this like beautiful, pristine property in the very best market in order to make money, right? But I think, like one of the things that arrived in real bricks both seem to be doing is buying brand new construction. And I think that's part of, like, it's a safer way to invest is the thought process. But safety, in my mind, the number one thing that you can do to have a safe investment is to get a good discount, right? To get a good, um, to have a good basis, right? I mean, I think that's almost any investment, if you buy it cheap enough, could be a safe investment because, assuming it doesn't have a zero or negative value, which is not always a safe assumption. Um, I say that, also having, in general, being like properly structured, low leverage, having a good business plan, having a strong team, like all of those things could be, um, things that make your investment safe as well. It's so, I, I guess it depends on the investment itself and the strategy, but in general, yeah, large reserves, all these different things can alleviate some fear. Sometimes they can be a good thing. Sometimes you're actually paying too much, in my mind, to alleviate that fear, right? Like you see, sometimes people are making very suboptimal investments because they're trying to make a safe investment. Um, anyway, I'm going to move on from that. And I'm sure you could all identify different emotions. That's why it's one I didn't want to talk about too much because I think it's probably the most clear. Like, obviously, one of the things I didn't even put on my list, but that is sort of an emotional driven thing, is there's a lot of people, I believe, are making investments based on the pictures, right? Like they're like, ooh, that's a beautiful property. Let me buy that. I'd like to live there. Let me buy that. Um, there's a lot of people that are like things that work in theory but don't actually, aren't actually the benefit to you that you think they are. So this is like a lot of people are like, oh, the governance voting, like you just have more control over these properties than you do, on Lofty, than you do like on Mogul. You don't get to make any decisions at all. Well, yes, I think that that is technically true. But depending on who your co-owners are, uh, you might get to vote, but there's still an incredibly dumb outcome of the, because the other people voted, in a different way. And the response we always get to that is, well, you could buy more and vote more, but uh, I could, but I'm going to move the price up, to even higher, and it's not necessarily practical to do that. So I think that the governance structure on Lofty sounds really good. Like you have a lot more control than you have in some of these other investments. Um, but does it work in theory, or is it just a train wreck? So far, for me, it's closer to the latter. Although I have had some good outcomes, I've witnessed a lot of very bad outcomes on there as well. The other thing, the daily compounding, like a lot of people talk about daily compounding on Lofty. I did a video about this a while back, and I've done a lot of math around this. And in general, if you were getting, depending on the timing, you could actually do better with daily compounding, than monthly, right? Like if it was actually working exactly like that. But because of the timing of money, where in one, you're getting it all right away versus waiting 30 days for the last piece of that, um, the math really isn't on your side. With the current structure, depending on the situation too. I mean, there can be, really like sort of edge cases where, yeah, you maybe are better with them holding that money and dripping it out to you, but in general it's just not actually the case. It sounds really great because, like, if you had an interest rate that you were getting paid and it was compounded daily versus monthly, you'd be better off with the daily compounding. But if it meant that you were waiting longer to get paid, you're actually not. um, you're having, one of the things long term holds, right? That, like, a lot of people are like, in real estate, you buy real estate for the long term. And I think most of the time that's a good strategy. But a lot of the time, the best move for a lot of these DAOs is to sell the property that they bought 2 or 3 years ago, right? So one of the big pushbacks when I've bought up tokens and some that I think we should just sell is people say, "Well, I invest for the long term, right? That's what I do, so I'm going to vote against any sale until at least another 2 years." Literally, I've had people tell me that in the Discord. That, like, "Oh, I can't. I'm not going to vote for a sale right now because I'm a long term investor." And okay, well, we've lost money for the last 3 years. we want to lose money for 2 more years and then sell because in theory being a long-term investor works better. Like I mean it's this is it's a real it's actually funny that I've heard this a few times, this exact argument. And it doesn't make a lot of sense, right? Like once you realize a property is a loser, you should just cut your losses, right? Like there are better places to invest. Let's liquidate, let's get that cash and put it to use elsewhere. Like yes, holding for the long term works in theory. In some situations, it doesn't though. Um, One of this is like sort of an appeal to authority, like having an authority figure. You see this in a couple different ways. Like, so for example, the mogul team, and just because they do it doesn't mean it's necessarily they're not so like they focus a lot on, hey, we worked at Goldman Sachs. They talk about this is institutional quality underwriting and whatnot. And honestly, for them, I think I am very much, I'm a mogul fanboy at this time, right? Like they are probably, I mean, they're really one of my favorite platforms. I like Sol's Lot a lot too, but for like a traditional real estate investment, they're at the moment my favorite platform. Um, Again, it doesn't mean that I'm right. Doesn't mean that you're not going to lose money on there. You want to do your own due diligence, and it doesn't mean that I buy every single property that they put out, right? And I think that that's one of the problems is like some people will look at this, will see the average deal they put out being great, and then they'll buy every single deal. And are they going to have is every single deal going to be a winner? I just think it's not possible, right? I think you're gonna have some misses no matter how good your team is. But like the other one, Arrived really focuses on like we have, yeah, again, they're a Jeff Bezos backed company. The number of times I've heard that about Arrived is mind-boggling, and it doesn't really mean anything, right? Like yes, he's good at making money, but he's good at making money for himself, right? Not for me, a customer of his business. I'm not making money from Amazon. I send them money every month, right? I mean, so I think that that's important to understand the difference. The other thing too is like in the co-owners, right? Like you start to see some people have it like co-owners like Earl, like and I like Earl a lot. I think he does a great job. A lot of people buy his properties, and just every one of his properties at the moment, actually, this is one I'm invested in. I think it's actually a nice low price relative to the due diligence that I've done on it. Um, but there's been times where all of his properties were trading at a much higher premium, really just because of the halo effect of, he's in the Discord a lot. He's very knowledgeable. He's done well on some properties, and I'm sure people are just buying his deals without looking at the deal itself, right? Not saying that they're not good deals, but I know people are just doing that. I actually think that some of his properties are just hurting right now, price wise, simply because he's had quite a few disagreements with people in the Discord over how to handle some of the turnover because he's dealing with just an unbelievable number of uh, terrible properties and situations for DAOs because he took over a bunch of the DAOs from Yom. And I think that, I think probably his co-ownership properties are being treated unfairly price-wise right now because of some of that disagreement going on with other things. So I mean, I think it can work both ways. Um, I think understanding who the team is, understanding who the co-owner is important, but you shouldn't just at no point in time will I ever just take everything they tell me at face value. Like I mean, you've heard me say a lot of great things about both Earl and like the mogul guys and other people on the platform too. Alec as well. Have done really well with Ario's properties, but I'm never going to buy into their properties without doing due diligence on that property. The other sort of authority thing that people look to is like the news or like research reports. That they might use it to pick markets. They might use it to decide where they think rates are going. One of the things, I mean, I do have a master's degree in land economics and real estate. You'd think that I would trust like economists, right? Like, and honestly, though, that degree was more of a finance degree, even though it has economics in the name. But I also did got a minor in economics in undergrad. Like, you'd think like I'd really, what I know is that like they can be wrong more often than the weatherman, and they don't get fired, right? Like just because somebody puts out, some specific, or maybe a YouTuber or whoever it is, some figure of notoriety or authority is saying this market's going to do well, these rates are going to go a certain direction. Nobody's good at predicting the future. And so, just because you hear that from someone, or people pick a markets like, oh, well, everybody's investing in Pittsburgh right now. Let me go invest in Pittsburgh. It's a terrible way to pick a market, right? One of the reasons I really like fractional real estate investing is I don't have to pick a market anymore. I can invest in a lot of markets. I can get that diversification. I can, um, I'm never going to make a decision around where I think rates are going to go, right? Like if you think about when I look at the mogul underwriting, I'm always backing out their refinance assumption. Do I think there's a good chance we'll be able to refinance? Yes. Am I just going to assume that we can? Like, no, I want to see what it looks like without that, right? Because um, no matter what everybody thinks about the direction of rates, they could go straight up from here and stay there for a long time, right? We've had high teens rates in the past. It could happen again just because it hasn't happened in the last 40 years. But again, just because there's somebody out there in the news or in some publication saying something, I always want to dig into the numbers for myself and really understand it. One of the things, I mean, you see these, some people are posting in the Lofty Discord ones that are like from some of the worst data analysts. Like there's like this one guy who's just been wrong about the market crashing for like 5 years, but every year still predicts it. And so I've seen people posting his stuff, and it's like, okay, well, eventually he's going to be right, but I wouldn't take it, for it's just like a worthless prediction at this time. Um, I think another big one, people kind of chasing prestige, right? Like you can see like the commercial properties get bought up on Lofty. Where'd it go? And actually, this is one I think is it's not necessarily a prestige thing. It is a commercial property. It was trading really high. It already also had very high yield though. But I think it is the reason that Leclerc gets bought up. The McDonald's. I think it's the vast majority of the people that bought Brownfield did so because it was a multifamily property. Again, kind of commercial. It's like not really thinking about anything besides that. You also see like the trophy short-term rentals, like the really just beautiful properties seem to sell well. The recent luxury long-term rental. I mean, there's definitely people that are ignoring math and want to invest in that because it's a nice luxury property. I've heard just a bunch of people say, it's one of the hottest markets in the country. Like according to who and based on what, right? Like I mean, I'm not saying that it's not. I'm saying that you need to like understand what that means, right? Don't just repeat it because somebody else told you that, and like just because there are a lot of $1 million properties being built there doesn't mean that that particular investment is a good investment, But I think that you just see these people, I have seen just over and over again, and again, I'm not saying that one's in particular or any one of these is not a good deal or is, but um, looking, that aspect of it, if that's something that you tend to fall for, and that's what I'm talking about, all of these blind spots, the reason I'm identifying them is if it's something that you tend to fall for, you have to identify that in yourself and counteract it, right? Like, oh, okay, if you're attracted to that trophy property or the luxury property, um, you want to really do the math on it and really understand, like, does that make sense or does it not? And I think, you see the same thing like certain markets. Like, there are people that want to invest in New York City so bad that they're willing to take a three cap, right? Or maybe lower even. I don't know. Like, and for me, like, I'm here to make money, right? I don't care. I will invest in an anthill if I think it's going to do better for me long term, than a high rise in New York City. Like I think that it just is your investments. They're not a reflection of you, right? Like their performance is, but the actual physical characteristics of those investments shouldn't be something that you have as a reflection of you. I think another thing, there's a lot of like laziness and rules of thumb that go on. So like when I was trying to talk to people about the liquidity pools, there was a lot of people that like were just like, If you invest in one side, it's like going long the property, and if you go invest in the other side, it's like shorting it. And it's like this is a very, it's a very lazy way to think about it. I think it's directionally accurate, but it is, you know, it's very incorrect. You could be right in your position you're taking and still not make any money, or not make any money for a very long time, because there's a lot more to it than that, right? So there's some of that laziness. There's a lot of oversimplified math going on. I see people do all the time calculating cash flow, without coming up with any vacancy or collection loss, without using any repairs and maintenance estimates. Excuse me. You see people like they're annualizing just a single month. Lofty is doing this all the time. Um, some of the other platforms, I mean, just really don't even give you enough information at all. Like when I was looking at Real Bricks, you saw me, dig into their numbers quite a bit to try to figure out like how they were even doing it. And actually, some of them had a number that was significantly higher, and I contacted them, and they were like, "Oh, that's right," and they changed the number after the video that I had sent out. So it is like doing this oversimplified math, or just it kind of goes back to taking certain stuff at face value, but or over annualizing things, or just annualizing something that doesn't make sense to annualize, like a short-term rental, like all of that stuff. If you're not doing a full, like really full underwriting, you shouldn't be looking at those deals, right? If you can't take the time to dig into the full math, and like I really like Mogul because their calculator is like breaks out a lot. Now, honestly, for me, I'd like even a little bit more detail. Um, when I've actually brought this up at one point, and they're like, most people that are investing in this don't really aren't even looking at the level of detail that we have. Like they have a lot that's built into their miscellaneous costs. That I'd love to see this broken out, but I understand that that's not their target market is not doing that. But like if you're not at least getting to this level of underwriting your deal, um, you're really you're really being too lazy. And yeah, that's one of the reasons that I constantly ask for historical data from Lofty, because without it, I'm having to like really try to build my own stuff on every single deal. But I do it because I just think it's it is lazy if not, and it's gonna there's very often that you can um, get led in the wrong direction by doing that, especially because if you look at like older properties versus newer ones, your repair and maintenance assumptions should be quite a bit different. If you're just ignoring that altogether, you're always going to pick the older property because the yields are going to be higher when you ignore maintenance, because you're getting a better deal because it's going to need some maintenance, right? So there's that. One of the things I heard a couple people make this mistake a few different times, but they talk about averaging down, right? Like this is a concept that I think makes sense, and this maybe should have gone into the poor analogs. I don't know, which is my next one. We're getting close to the end, so I think I knew this was going to be a little bit long. I think all of these are things that different people I've talked to are susceptible for, so I wanted to just get through them all. But so if you've made an investment in a property, it turns out okay, that property is not going as well as you thought. The price comes down, and I've talked about averaging down quite a bit, right? As the price comes down, I'm buying more and more, uh, provided the new price I think is a profitable purchase, right? Like. There, there was a discussion going on where the sale of the property was probably going to be net everybody, let's just say $20. Tokens were currently 25, but the person talking had bought most of his tokens at 50 and was saying basically, well, if I buy at 25, I'm averaging down my basis, so when I get 20, my percent loss won't be as bad. This was just a very lazy like look the way of looking at it, because if you stopped and actually do the math, yes, your percent loss is going to go down, but your actual loss is going to go up because you're buying at a loss still. So there's a lot of this kind of laziness um, around the thinking, around the math. If you're not actually running numbers on a property, or digging into the numbers that are provided. Like if Mogul's giving you the numbers, if you're not actually looking at each of one of them, testing like, do I think that's an assumption that makes sense? I think you're really messing up, right? I think that's the level of due diligence that should go into these properties. Unless you're just trying to YOLO into like hundreds of different properties and hope for the best. But like we've seen on Lofty, that's not a winning strategy. Could it work on Mogul where their average deal, in my mind, is a much better deal? I think it could, but I still think it's going to be suboptimal, right? I still believe that you're going to do better by picking, by kicking out, by identifying a few that you think are going to underperform. And this is one, so going into poor analogs, like people take a lot of these ideas from other realms of investing and bring it into this fractional real estate space. One that I hear quite a bit is stock market investing. A good example, I was just talking to somebody a couple of days ago or yesterday, I don't even know, about like, diversification and portfolio theory around, number of properties that you should invest in. And I think it's somebody who's knowledgeable about the stock market. And I've heard this quite a bit before is that, when you get past a certain number of stocks, it's really suboptimal because, but the reason for that is in when you're picking stocks, it's all about picking winners, right? Um, but it's because stocks can have a really high multiple exit, right? You're never going to have, a 10 bagger real estate deal like it's, over a short period of time, but you can in stocks. And so by getting more and more diversification, you start to dampen the effects of having picked some real winners. Um, that's what I think, if you listen to Warren Buffett a lot, like they're like, there's been times where they've said that he's talked about diversification really being stupid for somebody who really knows what they're doing, because at any given time there's only a few good investments out there. Well, the opposite is true in real estate, right? Like there are tons and tons. I mean, it's relative. Like I said in the beginning, there might only be four or five in my market every month that I think are great deals, but my market's just one of hundreds of markets, right? And so there's and that's just in any given month. So there's really unlimited deals out there. And none of them are going to be these crazy outperformers, right? Like you're just not going to buy a property and oh, it went up 10x. I mean, it's, there could be very limited scenarios where something like that happens, but in general, that's not what you're looking for, right? It's real estate investing is very much about not having big losers because you have much more risk to the downside than you have opportunity to the upside in general, with real estate deals. Because if you have a 20% return on your real estate annualized, that's an amazing return. You have stocks to have you can have a stock where you're having 100, 200, 300% return. Obviously that's not the norm, but those are the ones that you need to have. Like, okay, if you're doing a good job of picking winners, can be in there. But so because the real estate market and the stock market operate so differently, one, it makes a lot more sense to pick winners. The other, it makes sense to kick out losers. So the actual best size portfolio in those two scenarios is going to be vastly different. Um, but a lot of people will say, okay, this works in this, in the stock market. This is the same strategy I should use here. Where and I do a little bit of this because I actually think the real estate market is it's very similar to the fixed income market, and so that's also very much a avoiding losers market versus picking winners market. But it's all it's not a perfect analog either, even though I think it's a little bit closer. But so sometimes I have to catch myself and think about, okay, does this really apply? So a lot of the stuff you hear me talking about from Howard Marks, he's been a fixed income investor, right? And so a lot of that stuff I think applies, but sometimes I have to stop and really think like, okay, does it in this scenario for this deal, for this structure, right? Because some of these structures that we're seeing are a lot different from a traditional real estate deal. And so in those situations, I have to stop and think, like if you're buying a DAC on Saul's lot, what's important to you is going to be, and I think you've seen, if you've seen some of my videos on Saul's lot, the things that are important to think about are not necessarily the same things that you think about with a real estate investment in general. Like for me, the biggest mover of my return on these is going to be picking ones that I think are going to sell the quickest, are most likely to make it all the way through escrow, not have to be put back on the market. Um, so yeah, making sure that that there's poor analog. Another one is like people keep talking about the universal lending DAO or any of the lending DAOs as if they have a lien on the property, and they don't have a lien on the property. And in many cases, it is a vastly different situation. They have a mechanism to liquidate the property, right, to force a sale, um, but they don't have, liens give you certain protections as a lender that you're just not getting in these lending DAOs. And so I think that's a really poor analogy, but you hear people just saying it as if it's the same thing quite a bit. Um, and then one that I really just have to take other people's words for is that the liquidity pools in Lofty operate like much differently than the liquidity pools a lot of the crypto guys are used to. I don't know anything about that. But if you're just coming here and you're assuming it's going to work exactly the same, and it's not a good, it's not a good analogy. The other thing with the liquidity pools is the thing I talked about earlier, right? Like people, analogizing like it's like taking a long or a short position in this stock, in a stock, but it's like, nah, it's really not because the mechanics of it are vastly different, and that what determines whether or not you're profitable at the end of it is has a lot more to do with volume, um, and other things, right? And so, that poor analogs, I think I should have a much bigger list of this, but I sort of ran out of steam when I was putting this list together. But I know that there's quite a bit of this that goes on where people are like just comparing this market to something else, and it's just even just trying to compare it to investing in real estate in real life. To a certain extent, you have to just slow down and think, is that really the case in this particular scenario? Are we getting the same tax treatment? Because on a lot of the sites, we're not, right? A lot of them, you're actually getting paid like it's a REIT, or you're getting paid, just like it's a stock with a dividend. Um, some of them it's sort of, you're getting the benefits. Some of them, it's really, um, you're going to get a K1, and it's going to be almost exactly like uh, you have an investment directly in the property. So it's going to vary from one to the next, and how closely it resembles just you investing in real estate. Anyway, those are all the blind spots that I've at least, to make it on this list, it had to have come up at least a few times from people. Some of these came up a lot of times, and I think that it's just something that if your investments aren't performing as well as you expect, really think about, like, do some of these things apply to me, right? Like, and I know, like I said, a couple of them I identified as issues that I had, and some of them I think that I've overcome, but I try to constantly identify those blind spots that I have, talk to other people. That's why I think sharing info in the Discord is so helpful, really talking about deals, because there's always times where somebody's brought something up that I just didn't even think about, because maybe it's not how things work in my market. Maybe it's not, it doesn't match with my worldview, but okay, maybe it makes a lot of sense. So if you have, I think that identifying it first and then coming up with sort of mechanisms that you can put into place to help avoid it in the future, is something that is important. So if you do have known blind spots that have gotten you regularly, put it in the comments or jump in the Discord and let us know. If you think you don't have any, but you're still not making money, let's talk, because I think that there's definitely things that I don't think that that's the case, right? I think these platforms as a whole, if you really look at them, you do due diligence. There's a lot of opportunity to do well, um, and I think that if you're not making money, if you're on average losing deal money, even on Lofty, which the average deal is a loser, uh, it's not a hard platform to make money on. And so it's one that you have to spend more time, really understand those deals. And so, yeah, let's talk about it if you're having issues, but none of these really hit you. I bet you one of them is actually affecting you. And if not, maybe there's some that I have to add to the list and that I didn't. Um, anyway, that is a lot of monologuing from me. Please do the thing with the bell. Go ahead and subscribe. And if you haven't already, it's been growing a lot lately. It's kind of cool to see that. More important than anything though, jump in the Discord and be active in there, because I really think the more that we build a community where we're all trying to help each other, the less impact a lot of these issues are going to have on all of us. So anyway, until next time, I'm going to just keep making mistakes so that you don't have to.